Risk Parity Land. This is Justin with Risk Parity Chronicles, bringing you a quick YouTube tutorial on how to use the mutual fund and ETF factor regression tool on Portfolio Visualizer. Wow, that's a mouthful. Okay, this post and the video are in reference to Risk Parity Radio, episode 242, published beginning of February or so, middle of February. And in there, there's a question from longtime listener Alexi that really probably should listen to before watching this video. It is from 2 minutes and 53 seconds to 6 minutes and 26 seconds. I'll put that link in the show notes and in the blog post, of course, that accompanies this video. So go ahead and listen to that first. If you wish now, just a little summary, in case maybe you listened to it already, just want a little quick refresher. Alexi mentions a way to look at factors in mutual funds and ETFs. So when Alexi's searching for a particular factor in investing, he uses the Portfolio Visualizer tool to do that. And so he wrote in to Frank of Risk Parity Radio and kind of asked a little bit of a question about how to find ETFs and mentioned this tool. It is a very handy tool, but as Frank said in the Risk Parity Radio episode, it's a little daunting to use. Well, I heard that and I thought, well, one of my missions is to make things that seem daunting a little less so. So I put together this video to show you all how to use the factor regression fund tool on Portfolio Visualizer. So now this video takes with it as a given that you are going to try to invest in a factor. Okay, so I'll get to that in a moment, but well, what a factor is. But assuming you know something about factor investing, if you want to find a fund to invest in that factor, of course, then you want the most of that possible. As Alexi says in the snippet, if you want momentum, then you got to look for the ETF or the mutual fund that is the most momentum-y. If you want small cap value, then how do you find the most small cap-ish, most value-ish, that kind of thing. So assuming you want one of the exposures to the factors, this tool will allow you to search through all of the funds to find that. Okay. Now a little brief detour into factors. Now this is the subject of thousands of dissertations, and there are thousands of professionals on Wall Street dedicated to factor investing. This is way beyond anything I could possibly cover simply and comprehensively at the same time. So let's just say that if you are investing, there are some known aspects of companies and funds, because funds are just combinations of companies, right? That are distinct risks. And because they are distinct risks, they have distinct higher expected returns. That's the theory, okay? And it's a well-supported theory. It's not universal, as I'll explain, or as I'm explaining now, I guess. There is broad acceptance that these factors are true. There is some disagreement of whether they're always going to be true, whether they're based on the companies themselves or just the behavior of investors. There's sort of a lot of variations to this, but just for simplicity's sake, let's just say that we've determined in sort of all of the analysis of the markets that there are certain aspects to companies that make them have higher expected returns. Okay. There are a couple different factor models. There's a 3-factor model, a 4-factor model, and a 5-factor model. Now they sort of come all from the same place, which are Fama and French at the University of Chicago. But since the big seminal papers on seminal paper on this, I think it was 1992, there have been updates, and there's some disagreement sometimes about some of the updates. Some people have taken it in a new direction. There are people on the hunt for new factors all the time. I heard it on one podcast called The Factor Zoo, because people have determined there's 400 or so, but not all of those are distinct. Some of those are just variations on the theme. Okay. There's also 3 ways for calculating the factors. There's the classic Fama French way. There's an AQR way, and there's an alpha architect way, and I mentioned those because those are on this tool. I'll be using the Fama French method here, but you can use the AQR method and kind of compare notes, or the alpha architect. They're going to be similar, but not exactly identical. All right, so let's really briefly just kind of go over what those factors are. So we'll focus here on the 3-factor model first. You have market, the exposure to the market, which is how volatile it is compared to the market as a whole. And what they found is that stocks that have more volatility, that's an example of more risk. So there's a higher expected return over the long run for those high volatility, high market factor exposure companies. Okay, number two, and this would go through all of them, size, and this is also, not everyone agrees on this one, by the way, but there's been a sort of general recognition that small companies have a bit more risk than larger companies, so you can expect to be compensated for that extra risk. So we sometimes you'll see this as SMB, small minus big, so you get a higher number with that. It means you're focusing more on small companies. Okay, so that one runs through all three as well. Then you have value, meaning the price you pay for that company. So based on some sort of metric, usually PE ratio or price to equity, price to earnings ratio, or price to book ratio, or there's different ways to calculate it, but in a sense, getting a good value, paying less for a certain stream of income is better than paying more over the long run. So you'll see this as HML, high minus low. So high value companies tend to do better than expensive ones over the long term, and that's the value premium. If we go into the four-factor model, they've added another one called momentum, which is just sort of inertia. If a company is doing well, it will tend to keep doing well. And if a company is doing badly, it'll tend to keep doing badly. Again, this one has a lot of flavors to it, and a lot of people interpret it in different ways. But let's just say in general that the fourth factor that people have somewhat agreed on is that momentum is a factor. You also have here the five-factor model, where they take out momentum and they have two different ones instead. One of them being profitability, just companies that earn more are going to do better than the ones that earn less, right? And investment, ones with a conservative approach to investment and sort of, how would I say this? It's CMA, so conservative minus aggressive, that's another risk factor. Now, to be honest, I don't really know if I'm on board with this. For a long time as an investor, I was okay with this one. And then lately, I'd say over the past year, I've added, so I'm now down with the four-factor model. These two over here, these two extra ones, I don't know if I quite understand so well, so I haven't myself dabbled in them very much. But that's just me, and different people see it differently. Okay, so let's take Alexi's example in the question. He wanted to find funds. Well, he knew how. He was trying to show how to find funds that have a lot of exposure to momentum. So we're going to look for higher numbers for MOM, which is the expression of that. And then I'm going to cross-reference with value. So I want to look for things that have higher exposure to the value premium. So I'll kind of add to what Lexi did and kind of see if I can use a real-world example that would show how I would find a value fund with a lot of momentum. Okay. So let's get right down to the tool. I'll switch over here. We'll go to Portfolio Visualizer. And right here on the main page, it is this one right here, Fund Factor Regressions. Okay, so let's walk you through the buttons here. I mentioned there were the three sort of analytical models. There was FAMA French, there's AQR, and Alpha Architect. So we'll start here with FAMA and French. But feel free to switch that after you kind of see how it compares. The stock market, you have your different choices there. We'll just use the US. We'll do the four-factor model because that's what Alexi asked about or mentioned. So we'll start with there, but you can see that's where you change it. This is for fixed income, which we're not really going to deal with. This is the fund type, and this is actually pretty important because I first started doing all, but there's just so many closed-end funds out there. I found that it was kind of interfering with my search. So we'll do an ETF search, but probably you should look at mutual funds as well, which means you basically need to do two different searches. It would be nice if Portfolio Visualizer had kind of a checkbox thing where I could check ETFs and mutual funds instead of having two separate ones. But anyway, no aspersions on Portfolio Visualizer will be tolerated here. Okay, for fund category, you can do different types of things. We'll stick with U.S. equities. Time period is the default is 36 months, and you can change that if you wish, but that's just the time frame that you're looking at. R-squared threshold above 80%, so they're looking for things with statistical significance. So speaking of statistical significance, right here, there's these 5 things that you can check, and then you're going to limit it to only things that are statistically significant. But I wouldn't recommend checking any of these just for a little coding issue with Portfolio Visualizer. If you check those, there doesn't seem to be a way to uncheck them. At least that's what I had as I was testing this. So I had to basically start a whole new browser just to kind of clear that. It was just always going back to the clicked version. So maybe that's just me, but I wouldn't mess with that. Instead, just look for the things that are in bold, because that's the system that Portfolio Visualizer uses. All right, so with that, I've got all that in there, and you just update the table if it's not already updated as you wish, and then you can just sort, and that will be so that's how it first started, and that's the ascending from low to high. So we want the opposite. We want the higher to low. Now, Alexi in the call mentioned that QMOM was better than MTUM, and you can see a perfect illustration of that here. For this time period, QMOM is at 0.78, and MTUM is down here at 0.39. So if you want momentum, QMOM will deliver more of that than MTUM. All right, let's cross-reference it a bit with value. So I want to look at high minus low, and I can't do a kind of double sort here and kind of eliminate certain things, or sometimes with the screeners that you have a certain threshold. So I'm just going to kind of look at without altering it, what's their score for value. So in this case, QMOM is at 0.19 and MTUM is at negative 0.06. So there, QMOM is also better for value. Okay, if I wanted to, this way I can kind of see what are my valuiest funds with higher momentum, and I would get not a lot here, right, until I get to the second page. I'm just looking for positive numbers over here on the MOM. Oh, this is a good one. All right, DWMC. All right, I've never heard of this fund, but just according to the numbers, that's got a high value score and a high momentum score. So that might be something to look at a bit more. All right, so I think that about does it, and that is how to use the tool. All right, so getting back here to the summary, hopefully that's not as daunting with a little bit of a YouTube video. I do make this part of my ETF analysis process when I'm dealing with factors, which is not all the time, but in addition to sort of looking at correlations and performance and sort of how it fits with the other funds I have, then I'll look at the factor scores. And just in general, it's always good to have tools in the toolbox when you're looking for things. Hopefully you can add this to your repertoire as well. Any feedback is welcome at riskparitychronicles@gmail.com. And please continue to follow the blog at riskparitychronicles.com and also on Twitter at RP_Chronicles. Thanks very much. Bye-bye.